Home Depot and Lowe's have a duopoly on home improvement retail, but their net income and revenue are declining while interest rates are sky high. Although their share prices have corrected, and this may be the buying opportunity we've been waiting for, today's video will be an in-depth analysis comparing Home Depot to Lowe's, covering business operations, fundamental, and technical analysis. Home Depot and Lowe's have nearly identical business models with subtle differences and a few major differences, which we'll get into. Both retailers operate stores in every U.S. state and Canada, although Home Depot also has 138 stores within Mexico, while Lowe's does not have any stores in Mexico. Home Depot currently operates 2,355 stores as of the end of 2023, while Lowe's only operates 1,746 stores, making Home Depot the largest home improvement retailer in the U.S., not including the foreign stores. Better yet, for Home Depot, their store count has grown every single year since 2011, while Lowe's has had some major cyclicality, and their count has actually been shrinking lately. Oddly enough, like the two are in some secret operation together, they both own 89% of their stores, while the rest are leased. You're probably familiar with the products that these retailers sell, but they break down their revenue into various business segments, with Home Depot having three primary segments. Number one is building materials, which makes up 37% of revenue, followed by decor at 33% of revenue, and lastly, at 30% of revenue is hardlines, which encompasses hardware, indoor garden, outdoor garden, and tools. Lowe's, on the other hand, breaks down their revenue into much smaller categories, with their largest segment by a significant margin being appliances at 14% of revenue. Home Depot also disaggregates their revenue further and has appliances as their second largest single business segment at 9% of sales, while their leading business segment is indoor garden at 9.7% of sales. Otherwise, they're generally well diversified across their segments. Now let's cover the macro level benefits or pros of buying into either of these companies. The first pro that comes to my mind is that these stores operate a duopoly in home improvement across the entire United States, with only minor competition in various categories, like in hardware with businesses like Ace Hardware, or in lumber with Dixie Line Lumber. But they are virtually the only one-stop shops for all of these products, as they have squashed most of the competition over time. Another great advantage to their businesses is that their products are fairly large, which insulates them from online retailers, who can otherwise beat them in price and shipping, as larger products are more costly to ship. Better yet, many of the products that people buy from Home Depot or Lowe's are needed the same day. Another subtle advantage to retail businesses like this is that they simply sell the products that other companies continue to innovate and compete over, while Lowe's and Home Depot just stock the shelves and make profit from their sales, which I think is generally an undervalued advantage to traditional retail. Their lack of need to innovate and the duopoly that they operate has proven itself in their selling, general, and administration costs, which has only barely grown in Home Depot's case by 1.2% since 2022, while other businesses continue to struggle during these inflationary times. It also helps that they both own the majority of their stores, 89%, which negates them from paying increasing leasing costs throughout time. Although I recently covered a phenomenal business, Ulta, which leases every one of their stores, and fundamentally, they are world-class. One more subtle but huge advantage to their business models is that they don't need to advertise. If you need their products, you know exactly where to go, and you have basically two options. Home Depot and Lowe's have essentially identical businesses, but Home Depot has two major advantages over Lowe's. The first being that Home Depot operates stores in Mexico, and they are continuing to grow as they have established a foothold in that international market, while Lowe's does not operate in Mexico, limiting their growth. Worse yet for Lowe's, their store count has been variable over time, while Home Depot stores have grown every year since 2011. And for these businesses, stores are the foundation of their growth. Now we'll consider the macro level cons or potential risks of home improvement retail. The first is that the American economy is struggling due to high interest rates, and these high interest rates directly affect new home construction. When interest rates go up, new home building generally goes down, which constitutes a meaningful source of revenue for each of these businesses. And with consumers having less money, some of them will defer home improvement projects. Another potential risk that is partly tied to macro-level economic conditions is theft, which mainly seems to be affecting Home Depot, as they have a more relaxed security enforcement system compared to Lowe's, and theft has been rampant at Home Depot because of this. Now we'll check out the most meaningful metrics for analyzing a business, starting with revenue. Here we see Home Depot's revenue, which has grown from $83.2 billion in 2015 all the way to $152 billion as of the trailing 12 months. giving them an average growth rate over the decade of 7%, which is substantially lower than their last 12 months growth rate of -3%. Now we see Lowe's, who grew their revenue from $56.2 billion in 2015 to $85.4 billion, giving them a substantially lower average growth rate of 5.2%. And compared to the trailing 12 months growth rate of -11%, we see they are facing some significant headwinds in general and compared to Home Depot, giving Home Depot the win in the revenue growth category. Switching to Home Depot, we see their earnings per share has grown from $4.58 per share to $14.9 per share, or a 10-year average growth rate of 15.6%, which again is substantially lower than their TTM growth rate of -9%. Again, we see Lowe's, who finally appears to have an advantage where it matters, having grown their EPS from $2.69 per share all the way to $12.50 per share as of the trailing 12 months, giving them an outstanding growth rate of 20.7%, although their TTM growth rate is diving fast at a rate of -10%. So Lowe's wins by a long shot in the EPS category. Next, we see shares outstanding for Home Depot, and we can see why the EPS growth is so much higher than revenue, which is because they're buying back shares at a compound annual growth rate of -3.0%, which is a substantial reduction rate, but compared to Lowe's, they are far behind, who's reduced their shares by a phenomenal CAGR of -5.1%. which explains the huge discrepancy between their revenue growth and their EPS growth. So Lowe's is starting to prove itself and wins the share buyback category, but we want to find out if either of these companies are accruing debt in order to reduce their shares or sustain their business. Home Depot currently has a total liability level of $77 billion, which is 5.2 times their TTM net income. Not bad, especially compared to Lowe's, whose total liability is at $60 billion, which is much higher compared to their TTM net income level of $7.2 billion, or 8.3 times net income. So Lowe's looks to be buying back shares using substantially more debt than Home Depot, which is inflating their per-share metrics, while Home Depot is growing their net income more organically. So Home Depot wins in the debt-to-net income category by a meaningful margin. Now we'll look at these two companies from a dividend perspective, as many investors are looking to invest for the income or income potential in the future. First, we have Home Depot, and one of the most important metrics to consider when evaluating a dividend investment is the payout ratio, as this determines dividend sustainability. The average payout ratio over the last 10 years is 48%, while their TTM payout ratio is only 43%, which indicates current financial stability, as the most recent payout ratio is lower than the past average, and a payout ratio of 43% is modest for a company of Home Depot's maturity. But here is where Lowe's really shines, having a payout ratio average of only 35%. Which is identical to their TTM payout ratio. So Lowe's wins in the payout ratio category, which is a very important metric for future dividend growth and sustainability. Now we see the dividend growth rates for Home Depot over 3, 5, and 10 years, which are all double-digit growth rates, but their growth has been trending down over the years from a 10-year growth rate of 18% to a 3-year growth rate of only 11%, which is still quite high. If you didn't already predict that the growth rate would be higher for Lowe's, since their payout ratio and share buybacks are higher, here's what it did for their dividends. They have an incredible 10-year growth rate of 20%, a 5-year growth rate of 18%, and their 3-year growth rate is at its best yet at 23%, giving Lowe's a huge lead in the dividend growth category. So whose starting dividend yield do you think is going to be higher? Well, it's Home Depot with a starting dividend yield of 2.7%, while Lowe's starting dividend yield is only 2.0%, giving Home Depot the win in the current yield category. All in all, though, we can see that Lowe's is the superior dividend growth stock due to their share buybacks, low payout ratio, and huge growth rates. The last fundamental aspect of these companies we're going to look at is the price-to-earnings ratio, because what you pay for a business is arguably what matters most. Home Depot's TTM PE is at 22, which isn't even a discount compared to their 5-year average, which is also 22, meaning the market has already priced in their recent earnings decline. But for Lowe's, there's a bit more value to be had with a TTM PE of only 17, which is much lower than their 5-year average of 22, 20% lower, indicating the market has undervalued Lowe's at its current price, or that there is significant downside to come. In summary of the fundamental analysis, I think Lowe's wins due to their better per-share metrics and current valuation. Although from a store growth perspective, international diversification, and fundamental robustness, Home Depot wins. If you think Lowe's wins, you can cast your vote by leaving a like, and if you think Home Depot wins, leave a comment explaining your thoughts. Here we have Home Depot over a 5-year period. And the first criteria I'm checking for is an uptrend over this time frame, which is the case for Home Depot. Next, we see the standard deviation channel, graphed at these three yellow lines. This tool determines the average price for a period, depicted by the center yellow line, and the price is currently only slightly below average, roughly 6%, not indicating significant value. In terms of support and resistance, price looks like it recently broke through a meaningful support level around $333 and is retrying to break that level as resistance now, which corresponds with the EMA lines, which are now establishing potential resistance rather than support. Last, we see the relative strength index graphed at the bottom of the chart, and we generally want to be buying when the signal line is at the bottom of the channel. The line is currently near the bottom of the channel, but price has gotten a bit high, and the RSI isn't correlating well with the truly low price point, like it did in October of 2023, which does not indicate a buy signal in my mind. Now we see lows over 5 years, and they're also in a well-established uptrend, which establishes our bias. In terms of the standard deviation channel, Lowe's is currently about 9.6% below the average price of $246. Which is a better deal than Home Depot. In terms of support and resistance, Lowe's recently tested support around $213 and appears to be holding this level. Last, we see the RSI, which is slightly below the middle of the range, not indicating a particularly good buying or selling point. In summary of the technical analysis, Lowe's is at a more favorable buying point than Home Depot, but neither companies are at an exceptionally good buying point, and high interest rates could still have a further negative impact on their earnings. I'm not buying either of these companies, and I see better current value in stocks like J&J. Thank you for watching. I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.